This is an update on the energy sector and our oil fund, Brompton Energy Split Corp, highlighting the recent changes to the mandate. So before I dive into the energy update, just a little bit about the fund. It's the only split corp in Canada that is focused on the energy sector. It's got a Class A and preferred shares. So the Class A gives you leveraged exposure to energy, and the preferred share gives you steady income, which we just increased to 8.25% in the last year. So for more information on split shares, please see the split share primer on our website. The fund used to be called OSP Oil Split Corp. Since we launched it in 2015, the oil market has changed substantially. We've had the advent of ESG, the energy transition. We've had increased M&A with consolidation, so there's fewer companies that we can invest in, especially those that were in the universe allowed in the S&P 500 and the TSX. As a result, we've broadened the universe to include global energy companies that pay dividends. We allow more energy-related companies such as pipelines, services, renewable energy. It allows up to 25% in other resource companies. The goal is to broaden the mandate to reflect the new realities of the energy market, to give more opportunity for capital appreciation. Increased diversification should also reduce the volatility of the portfolio. The world still needs energy. Energy consumption is proportionate to the growth in the population and to the wealth in that population. We still need energy, especially to maintain our lifestyles. And energy security has become more and more important. We've seen that after the Russian-Ukraine conflict. So this chart shows that the energy needs are growing in the future, and we expect this mix over time to change. Less fossil fuels, and you can see that in different shades of gray, especially coal, which is in the light gray. Increase more renewable energy, and that's in light shades of blue, and nuclear in dark blue. The world still needs oil. On the left side, you can see the oil intensity over GDP has actually decreased over time. We expect this to continue with renewables and becoming more energy efficient, but the world still needs oil to grow economies. On the right-hand side, you can see the oil consumption per capita has actually been very stable over time. It's been almost flat for 50 years. So if you expect the population to grow, which we do, oil consumption will continue to grow. We also believe that the world will get wealthier and use more oil. So for instance, people in emerging markets want the same lifestyle as we have in North America. In the United States, they use 22 barrels per capita versus China, which is 3.3 barrels, and India 1.2, and Africa 0.8. So in 2000, fossil fuels were about 86% of the energy mix. Fast forward 23 years later, it's down 4% to about 82%. And over the last decade alone, we've spent over $5 trillion on renewables. Yet over this time, the hydrocarbon demand actually went up 45%. So remember, we convert the easy stuff first, like the coal, and the next 4% will be harder and likely cost a lot more money. So what is oil used for? This is the oil demand by sector. So as you can see, not much is used in electricity, about 5%, because that's already been substituted away. So the next will be harder to substitute, like petrochemicals, rail, and marine will be very difficult to substitute. So what governments are trying to concentrate on is that 45% that is used for road transportation with electric vehicles. So if we drive a car off a lot, you can still usually use that for 12 to 15 years. So it'll take a long time for the penetration of the fleet for EVs. Even if 70% of new vehicles are electric vehicles, which they clearly are not, half the vehicles will still be internal combustion engines by 2050. There are serious barriers to adoption of electric vehicles. Number one is a higher initial cost. If you don't drive enough, really the economics don't work, especially with the higher financing costs. You need subsidies. And most people, if they do have electric vehicle, that's usually their second car, because their first car is an internal combustion engine. And why? Well, there's just not enough charging infrastructure, even in developed markets. So if you live in an apartment or if you park on the street, even in Europe, many don't have a garage. For instance, the CEO of BP, when I saw him, he told me He doesn't even have a garage. So we do need incentives. We need government support. For instance, there's the IRA in the United States to help build that charging infrastructure. And in emerging markets, other than China, they've been very slow to adopt because there's simply no infrastructure or incentives. And then there's also the amount of time to charge, which is obviously longer than it takes to fill a tank of gas. There's range anxiety. We need charging infrastructure on highways, and the grid may not be able to handle that infrastructure. Number of models is increasing, but people aren't buying. There's lots of parking lots full of electric vehicles at the dealers. So GM dealers have actually asked GM to develop hybrids since their strategy has just been EVs. And many customers are just not ready to go full on EV. So I've talked to clients across Canada. Many can't even buy an EV because the grid where they live cannot handle it. For instance, in Ontario, Hydro One, these blocks cannot handle more than 2 EVs per block. And then there's other issues. How do we get enough lithium, copper? How do we recycle batteries? So next we talk about oil supply. So this is we concentrate on the US, and we've seen the US, the well productivity is declining, and the oil rig count is also declining. And part of the reason why is under $70 oil, 25% of all the US shale is actually uneconomical to drill. In 2024, we expect more supply growth from the US, but less than 2023, and also supply growth from Canada. After all, TMX is coming on, delayed, but it will be on, and Guyana and Brazil. With ESG concerns, we've seen less capital being deployed. Russian supply has actually been strong despite expectations that sanctions would lower production, but we believe they've maxed out capacity. They're having trouble selling their oil with a $60 cap, and they currently have a currency dispute with India. India wants to pay in rupees, Russia wants yuan, and part of the reason is Russia's got a lot of rupees, but they have nothing to buy from India. They prefer Chinese yuan so they can actually buy goods from China. Iran looks like they've been maxed out. Production actually grew 1 million barrels a day under Biden. And we don't expect any more releases from the Strategic Petroleum Reserve. It's really at the bottom of the barrel. So supply is turning into demand there. OPEC Plus, which really means Saudi Arabia, has actually done a great job holding the cartel together. Brompton believes Saudi wants $70 to $90 Brent. Saudi initiated the second round of cuts when oil was $70 and did not even increase oil production when oil was over $90. We're currently trading at the bottom of the range. Saudi has cut 2 million barrels a day. Let's assume that if they did not cut this production, oil prices would fall to $50. So by cutting 2 million barrels a day, they actually got $100 billion more in revenues. This plan is working very well for Saudi. Saudi is reducing spending plans. They had planned to increase capacity to 13 million barrels a day. They're not doing that anymore. There are cracks in OPEC. They have lost Angola, but they're actually adding Brazil. Truth is, Angola can't increase production. Brazil is actually much more important to the oil market. And contrary to popular belief, oil demand has actually been very good. Pre-COVID, demand was 100 million barrels a day. Now demand is 102 million barrels a day. Spare capacity should increase slightly by the end of the year. With a slowing global economy, expect supply growth to slightly exceed demand. By mid-2024, Brompton forecasts OPEC may be able to reverse some of these cuts as the underinvestment tightens the market. By 2025, the call on OPEC will be reduced by 1 million barrels a day. We think Saudi will keep the coalition together and maintain production cuts. With the rise in geopolitical risk with Israel, Hamas, the Houthis in the Red Sea, not even counting the Russian-Ukraine conflict, and now Jordan with the killing of US servicemen by the resistance of Iraq. Venezuelan output could also fall by 30% if Biden reinstates sanctions. Biden wants Venezuela to hold free and fair presidential elections. With the upcoming elections in the United States, it's a difficult balancing act for Biden. He wants to keep the prices low. To do that, he's allowed Iran to produce oil. But at the same time, that extra oil allows them to fund rebel groups. And Biden also wants to look tough on terrorism. So there's a potential this could be a replay of 2019. And what happened in 2019 is US reimposed sanctions on Iran. And Iran's attitude is, well, if we can't sell our oil, nobody can. Iran sponsored militant groups. They target oil infrastructure, such as Saudi's oil processing facilities, Straits of Hormuz. If they target the Straits of Hormuz, that's a key choke point because 70% of all oil traffic flows through there, and we already have a choke point through Red Sea, which is 5%. So there's a potential for this to happen again. We're watching carefully to see if these conflicts continue to escalate. Biden knows that he could lose the election if the war does not de-escalate, so he is trying to resolve this. We believe that the oil market is very complacent because the risk of conflict is actually escalating. We expect oil prices to be range bound into $70 to $90 range this year. So moving on to natural gas. Natural gas, as always, is dependent on the weather. It's been a very warm winter with El Nino, and the truth is Europe has enough gas. So with the lower prices, the gas rig count has dropped about 23% last year, and we're trading around the bottom of the range. The story is more about the future with more LNG terminals being built in North America. So in Canada, LNG Canada will increase by almost 2 BCF a day by around 2025. US capacity is scheduled to double by 2028, 2029. So Biden has paused the permitting for new LNG exports and corporate climate change. It's really not going to impact those under constructions because we've permitted about 20 BCF a day in the US. And to give you an idea, current LNG capacity is 13 BCF a day, or the North American market's 95 BCF a day. We're going to be increasing the demand by over 20% in the next couple of years. And the delays will really affect only those planned after 2028. These have limited impact. So the business models for oil and gas companies have substantially improved over time. They went from growing production at any cost to growing profitability. They are now concentrating on economics, return on equity, return on capital employed, and they've really constrained capital. They've been paying down debt since this is a cyclical business. They've become more shareholder friendly, returning capital to shareholders via dividends, special dividends, and share buybacks. So most companies are approaching or have already reached their debt targets. The free cash flow conversion to shareholder returns is actually increasing. That's why we're showing free cash flow yield. It's the best across all the sectors. Valuations are attractive on any measure. We expect more dividend increases and share buybacks going forward. Now we'll move on to energy metals. Copper is one of the biggest beneficiaries of the energy transition because you need copper for transmission grids, renewable energy, and electric vehicles. For instance, electric vehicles roughly use 3 to 4 times more copper than internal combustion engine. Copper demand is currently driven by China residential construction demand, which is struggling after overbuilding for many years. But we see very high supply disruptions this year, about 1 million tons a year or 2.5% of supply, and it's across the board. Rio Tinto, Anglo American, Codelco, First Quantum, Tecominco, all across the board. They've been lowering their guidance on production for copper. And one of the leading indicators is treatment charges. They've dropped from $100 to $20. Treatment charges are really the price that smelters charge to process copper. It's so low that a lot of smelters are shutting down, and that will further reduce supply. And really because these smelters are not making money. And investors still do not want companies to build new mines, especially greenfield mines. One good example with Tecominco's QB2, the capital went from 4.7 billion to 8.8 billion, and part of that was it was built during COVID. The incentive price for greenfield projects is approximately $3.65 a pound US. We currently don't own any copper stocks, but we are looking for opportunities in the future. So next is uranium. We're undergoing a nuclear renaissance. It's emissions free, and many countries regard it as green. We have seen more and more utilities entering the market to sign contracts. And part of the reason is supply is tightening. Old mines have not been restarted. The biggest producers, Kazatomprom and Cameco, have guided down production. Kazatomprom is having trouble getting sulfuric acid. They're having construction delays on their new projects. So we expect a supply deficit of 10% of demand this year. We like uranium, so that's why we've added Cameco to this portfolio. So this shows the portfolio subsectors. We made some changes in the portfolio with the new mandates. We've added Cameco in the coal and consumable metals. We've increased pipelines, midstream, and we do believe oil and copper are good inflation hedges. So these are some of the companies in the portfolio. So in terms of midstream, we really like the US midstream companies such as ONEOK, Targa, Williams. In terms of refineries, we have Marathon Petroleum. We added a global company, Total. In terms of gas, we have Tourmaline and ARC. So previously, we owned the takeover targets, EOG and Hess. We've since sold those. The ARBs have really taken control of those companies. And we believe this year that Canada can outperform the US names because TMX is coming on. And the result with TMX coming on, we're going to get better pricing. Canadian oil has gotten a price discount for many years. We believe that those differentials will come in and Canadian companies can actually grow their oil growth because we have capacity on pipelines now. So a bit about Brompton. We are a leader in income investing. We've been around since 2000, and since that time, we've paid out over $3 billion in distributions. We have a family of ETFs, and we are also known for our split corps. We have an entire family of them. So this is our split corp lineup. And as you can see, we have financials and we have broad-based offerings in Canada, global, and we also have a sustainable mandate. This is our disclosure. We have the performance, the oil split, now energy split, and this is also further disclaimers. Thank you very much for joining us for this energy update.